How about Salesforce.com? It's a very popular company. Stock ticker is CRM. One of the biggest software companies in the world. 50 billion market cap. We'll do it from scratch as well, because I don't think we have a Salesforce.com model. Nope. Cool. So we'll just put one together real fast. So last time we looked at it, stock is 71 bucks. It's still in that ballpark. So let's just make a model real quick and learn a little bit more about it. I think we all know it's a customer relationship management software, but I think they do quite a bit more than that now. So let's take a look, and of course I'll upload these files after we're done. I use one of Salesforce's products called Heroku. I don't think it's a big revenue generator for them, but sort of a mindshare generator. Shut up, kitty. Shut up. I said shut up. All right, so number of shares outstanding, 685. 50 billion enterprise value or market cap. Let's see what the enterprise value is in a second. Shut up, kitty. Cat has joined me, my junior analyst here. All right, so 2 billion in cash. There's a convertible note. There's a term loan. You want to trade the term loan, kitty? You can't. So roughly the same amount of cash and debt. The cat's down here if you want to see the cat. Shut up. Let's see. There's a loan on a building probably. Shut up. All right, looks like the balance sheet, we got most of that. Let's see, subscription and services. IFRS. I unfortunately have painfully learned both IFRS and GAAP. All right, that's a lot of revenue. So yeah, a long time ago, Salesforce went on its mission to compete with Oracle in CRM software. There's two companies called Siebel and PeopleSoft that made CRM software for the enterprise, and it was the old school clunky enterprise software. And then finally, web services was the old name. Now it's software as a service, or whatever you want to call it, is sort of taken over. We got 2 billion in quarterly revenue. A year ago, that was 1.6 billion, so pretty rapid growth has characterized the company. Let's take a look at what percentage that is. About 25%, I want to say. Yeah, 25% revenue growth. All right, like most software, I would imagine that it's an enormous margin. I'm just going to loop together the entire gross margin line. 75% gross margin. If you just did the we used to call license revenue, but now we call it subscription revenue. This includes the services margin, which is very low. You can see the services, they actually lose money in the services, so subscription is closer to 80% margins. All right, so now they have marketing and sales. To sell this kind of software, you need a Salesforce. It's interesting. According to GAAP, they're basically break even. Let's see what cash flow statement tells us. That is surprising. And we'll talk about how to look at companies at scale as well. All right, so they include stock-based comp, which makes a lot of sense. We have to think about how to look at that in a minute. You can see cash flow from operations is $250. Let's just jot that down real quick. See, I'm a little bit at a loss here because it says net income $229. And they don't bridge that, or maybe they do. Oh, including this benefit from income taxes, which is a valuation allowance already. So $250 million in cash flow from operations. Let's just quickly do CapEx and SBC. So CapEx. There it is, 96 million. And then SBC, stock-based comp, 182 million. All right, so Salesforce.com is a $50 billion unprofitable company. Pretty amazing. I think this has been a problem, not a problem, but a feature, if you'll call it that, of Salesforce for a long time. But again, you have to think about oh, you can't use the bad words in this chat. Sorry. No racist words, please. So anyway, what do you do when you have a company that's like this? You know, they're growing like weed, but they have no cash flow. You can still value it actually relatively easily because you have to think about scale and is this the R&D structure? Is this the cost structure that they're going to always have necessarily? And the spoiler, of course, is that no, they probably will scale differently. And what does that look like is a question. And we've seen that with companies like Amazon.com. You sort of have to use your imagination a little bit. But what you're actually doing is you might say, well, that sounds very hand wavy. I don't want to use my imagination. I want to see cash flow. Well, it doesn't really really work that way, because at the end of the day, the way companies like this work is they're reinvesting into these projects, and these projects may or may not bear fruit, but they're probably smart investments given the growth the company's seen. So we'll talk more and more about this as we plug and chug, but hang on just 2 seconds. I'll show you how we kind of manipulate these numbers to the point that we try to reflect reality, especially a future reality that could be a more scaled company. Yeah, an acquisition is still a project of sorts, right? They do have that sort of, someone called it delusional. I don't know if I'd call it delusional, but they have that sort of dreamer management team where they definitely want to take over the world. Okay. Let's go to their website. Well, they have a lot of growth. So it reminds a lot of people of, Amazon.com and things like that. 25% revenue growth is not easy to come by. Let's look at some. They have a weird quarterly, strange quarterly system here. There it is. Q1, Q2. Let's take a look at, this is Q4. So let me try to put the dates in here. Q4 is 1/31/16. Not many companies are growing at this rate, especially with this scale. I mean, this is a lot of revenue. So just consider that for a moment. The only question is, why are the margins so bad? Software companies usually have much, much higher margins than this. And we can get to the bottom of that, and we will in just a moment. Okay, you see the revenue growth has been quite sustained. Let's make sure we got these funky quarters right. All right, 3 months for, what is this, April 30th. Yep. Okay, now the last one is Q2. And now this is Q2 17, so we should probably redo this. All right, cool. Let's look at the, what are we looking at? This. 10/31/15. Okay. You can see the unbelievable trend where they had almost $100 million in quarterly revenue. 1.4, 1.5, 1.6, 1.7, 1.8, 1.9, 2.0. You know, really metronomic almost. You know, the cool thing about subscription companies is that their software, their revenue is very predictable. Because you know, if you're signing up for subscription revenue for many years, you know what your revenue will be the next several quarters. And we're going to talk about that dynamic and how it works with accounting in a minute. There's something called deferred revenue that we have to look at very closely for software companies. Tax line is so strange, but not uncommon for a company like this to have a bizarro tax line. All right, we're almost done with our quarterly financials, at least for the income statement, and then we got to sort of take a look at these cash flow statements, because you get a lot of funky things going on here with this company. Really complicated company from an accounting perspective to understand, and I would encourage you, if you really want to take on a complicated challenge, so you have things like gain on sales of land and building improvements, which is a little bit laughable, but according to GAAP has to be included. Hard to think of that as a recurring cost. All right, so 25% revenue growth has been very constant. We'll look at guidance. We'll look at cash flow. Where should we start? How about the most recent quarter? So let's take a look at the earnings release and read through it together. They have some currency translation, which makes sense. Deferred revenue, as I mentioned, is going to be something we want to track really closely, including unbilled deferred revenue, since these are leading indicators of revenue. They give us third quarter guidance of 2.11 to 2.12, and you can bet that that guidance will be accurate, given that 99% of the revenue is already scheduled to be received or is contractually obligated. So that'll be another 25% quarter, 25% growth quarter, as DJ Khaled would say, another one. Let's see if SG&A is growing 25% year over year. SG&A is their biggest expense. Doesn't seem, or not SG&A, but marketing and sales. Yeah, it's only growing 15% a year, which is great, right? When you have revenue growing faster than your biggest cost, that's kind of what you're looking for in life. You might also be looking for things like love, but in general, that's what I'm looking for in life. Faster revenue growth than operating expenses. So I'm just going to put in like a 15% tax rate, and we'll start to normalize basically what this company will look like. Leap year. Okay, so what's going to happen to R&D for this company? That's sort of the question. Let's see how R&D is going. Inevitably, R&D kind of has to slow down. And is R&D really related to the current business, or is it related to the legacy business? Related to new business. And so if you wanted to think about that, which I think you should think about really hard, my guess is that R&D is not a real cost here. Now, it's not going to save you much money, since it's a pretty small percentage of revenue. And the G&A is already leveraged in their scale. They have a pretty big scale. So this marketing and sales is the problem, and their cost there is pretty enormous. So it's remarkable that they're not more profitable. It's an $8 billion software company that's unprofitable. Haven't really seen that ever. I'd be curious to go back to Microsoft and Oracle's days and kind of see what kind of profit margins they had at that level. They might be kind of over costing or overspending, I should say, but something seems a little off here. So let's say they grow for 20% rate for a few more years, then I don't know, a 10% rate for a few more years, and then that's it. And I guess they can improve their margins a little bit. Let's keep it at 77. And then marketing and sales expense should slow down. There could be some stock option expense normalization there. We're going to haircut R&D, and we'll think about that as a normalized kind of running the current business R&D. And this guy, I'm assuming they're sort of at full scale for G&A. So on a fully scaled out model, they could be earning this makes a little bit. This is why they have a $50 billion valuation, because it would not take much other than spending discipline to reach this kind of reality. Now, I don't know what kind of tax planning they have. I'm assuming they'll pay a normal tax rate of say 25%. Let's do a little bit more math here. All right, moment of truth. $66 billion. All right, that is, for a first guess, is awfully close to the current share price. Yeah, so 85. The model says $85 a share. The stock's at $74 a share. Market is very efficient. So the market is basically telling you that it thinks on an 8% cost of capital, the company will go from roughly doing $8 billion in revenue a year now to $16 billion in 4 or 5 years, and then sort of stagnant at $20 billion, improve its margins dramatically, and that's sort of what the market's sort of telling you to do. 25% tax rate is pretty normal for a company like this. You can look at what the other companies pay. Let's take a look. Microsoft's tax rate is about 20%, 19% looks like. Oracle tax rate 20%. That's pretty normal. 25 is maybe a little aggressive, but we'll leave it at that. I mean, I truly think, let's take a look here. Let's operating margin. They have no operating margin right now, so it sort of doesn't really matter. Let's see what we have it going from break even to really dramatic. Yeah, maybe too dramatic. Too dramatic. But you know, that's the question: is how and when can they pour on the margin? We are all assuming that they can, but maybe they can't. You know, you never know with these things. I'm also haircutting R&D. Remember to correct for sort of a missing scale. I don't know. I stand by it. It's also, what's interesting is even if it's a little aggressive, what's kind of cool is that it's what the market is telling you is going to happen. Right? So by any combination, whether it be revenue, discount, and margins, you should be able to solve for and impute what the market is expecting. You can go watch the YouTube if you want to continue this Periscope, but I have to close the Periscope. So even if these estimates are, let's say they're ludicrous, and there's no way they can go from basically breaking even to a 40% operating margin, what's important is that the market's telling you that they can. And so if that is ludicrous, a short sale would be extremely profitable. So let's take a look at the cash flow statement a little bit more. Cash flow and net income converge eventually, obviously. Yeah, the autonomy acquisition was a fraudulent issue, I think. Fraudulent accounting, which in software, unfortunately, is very common. We're going to look at a company called CA, where some of the people behind that company ended up going to jail for accounting fraud. Let's see, deferred commissions. Prepaid. Software accounting is amongst the most complicated, and one day we'll try to tackle it. Call it revenue recognition. That's the big problem with software. Deferred commissions, non-current deferred commissions. Capitalized software. Goodwill. Capitalized software is probably good, just basically intangibles. Strategic investments are going to add as cash. Other assets. Okay. Now let's look at accounts payable. 67, 96. Now, deferred revenue we have to be very careful on, since this is truly important. Like I said, the thing about deferred revenue is it's a leading indicator for revenue. So we're going to have to monitor deferred revenue very carefully. And I think their deferred revenue is growing at 30% a year, which means that revenue is going to grow 30% a year, which is really promising. So you could actually have faster revenue growth than maybe we're thinking, including here. A couple more quarters of 25% revenue growth definitely boosts the NPV. Now to over $100 a share, and it's at 74 right now. All right, let's keep looking here. They have these debt instruments. First a convertible, and then a term loan, and then this Fremont Avenue loan. We added that other deferred revenue. All right, so the balance sheet balances quite nicely. Now we're going to do the cash flow. So we're going to say model net income and reported net income. And these two are very different because we're not playing their kind of game with the taxes. So our model net income is only 24 million. Their model net income, or their GAAP net income, is positive 229 million, mostly due to a tax adjustment. And so here are the other add backs. We have D&A. We've got amortization of debt discount, which is an accounting concept, amortization of deferred commissions, and of course stock-based comp, which is a really tricky one because even though stock-based comp is non-cash, it is an expense, and adding it back is not something that I believe in. And of course all of the working capital changes on the balance sheet. All right, so if we add all of this up, we get 250.678, which matches with their cash flow from operations, working capital, amort of commissions. Let's see, amort of debt and D&A. All right, now let's go to the acquisitions. So, big acquisition. I wonder who they bought. $3 billion. They're always buying someone. Ciao, kitty. Exact target? Yeah, I don't know. It was cute. It was the most recent quarter, so. All right, so with just this, we can actually do quite a bit of analysis. But let's do one more quarter. See, the total change in cash was negative 800 million, which is very telling for a company that's a 50 billion enterprise value. It's a really enormous quarterly loss. But again, I think, well, let's do some more math. Let's do cash flow from operations plus stock-based comp minus minus capex. Let's see what that looks like. So this is like true cash operating performance. Since stock-based comp for a company like this is close to true cash flow. And we can see they break even roughly, negative 28 million. Interesting. Now again, they do a little bit of extra R&D, and they have quite a robust growth trajectory, but it makes you wonder if your margin assumptions are really realistic, getting to 40% operating margins. But let's take a look at their cash position is very close to 0. Acquisitions isn't a part of CapEx because it's not part of CapEx. It's not a property, plant, or equipment. It's interesting, deferred revenue dropped. That might be a seasonal thing, but it definitely is not the sign of a growth company to have deferred revenue drop. If you see that very carefully, quarter over quarter, deferred revenue did drop. I went over deferred revenue a number of lessons ago on how to look at it and think about it. So they just took the term loan out, which we saw in the quarter. Other liabilities. Okay, balance sheet balances. You can see both the assets and the liabilities plus shareholders' equity is the same. But now let's go back to the cash flow statement. We'll see if Q1 was any different. This should be exciting. All right, now for this quarter, you see the modeled net income and reported net income are pretty close. We add back D&A, of course. We're going to add back the various amorts. There's a gain on sale. And then amort of commissions and stock-based comp. Collect all their receivables, looks like. These things ebb and flow. And we may find out, interestingly, that you can't judge a book by one quarter. So you can see here that the combined cash flow is much, much higher. Much, much higher when you look at 2 quarters. So this might have just been, you can see here in the working capital, they collected a lot here. So a lot of their accounts, you can see here, the accounts receivable specifically, they collected a ton of receivables. And in this quarter, they kind of extended those receivables, which is why we can't judge these things on one quarter. So I'm a lot more comfortable now with my margins going to 40% assumption. We'll see what the margins look like in a second. Here's CapEx. Aha. You get cash when the employees exercise their stock options. All right, so if we look at cash flow from operations plus stock-based comp minus CapEx, we get, well, we should actually, can anyone find the mistake here? There's a crucial mistake. Pretty sure. Yes. It's a crucial mistake I made. I'm trying to, as usual, it's not a huge mistake, but if you can point it out, I'd be very impressed. What's wrong with this line? Shouldn't add back DNA. Get out of here. It's added back already. No Rolex? No. So it's a very interesting line item. We can debate it as to whether or not it's a mistake. See if anyone can find it. Of course, whenever you're modeling, you're trying to find the true operating cash of the company. That's why I'm doing cash flow from operations. Ah, very good, Alex. It's missing the cash from ESOP. Now, what do you think? Is that reasonable to add? Is that reasonable to add? Because they're stock options that are exercised a long time ago, right? There's no bearing to today's stock options, really. And presumably, this expense is Black-Scholes calculated, it's fully calculated, and that expense is net of the cash received. So is it truly an operating... It's a really interesting question. I think you would look at both. I would look at both. It doesn't swing things enough to matter, but it's not nothing. So if you look at this, you've got $1 billion over 6 months, so maybe $2 billion a year in cash flow from operations. That's actually not bad at all. That's not bad at all. That's 25 times earnings for a really, really good growth company. And if you think about $1 billion in cash flow from operations over $4 billion in revenue over the same period, you're really talking about 25% net margins. So really not far from that right now. And the fact that deferred revenue is growing, that really is telling. So let's see if we can look at deferred revenue. That's an important line. Just as a reminder, deferred revenue is a leading indicator of revenue. Why it's booked as a liability is something that puzzles all first-year accounting students and financial students. But I'll let you guys worry about that. I'm a grown-ass man. All right. So now you see deferred revenue on this perennial decline. It's very worrisome. Very worrisome. 4.3, 4.0, 3.8. Why is that happening? Why is that happening? Do they have good reason? Let's look at it here. I guess they're now telling us to look at this unbooked deferred revenue. Unbooked deferred revenue. Which I don't like that. I'm not used to that. There's a huge jump in deferred revenue, so maybe a couple quarters doesn't tell the whole story. If you look at this, something funky here. I don't know. Wait a second. It's the same thing here. Deferred revenue, 3 billion. All right, so deferred revenue year over year is still up substantially, and it better bump up next quarter, right? All right, so we'll watch that carefully, but I'm pretty attracted to this. I like the idea that their margins are already kind of where I expect, and the growth is a little better than I'm modeling, but I just like to be a little conservative. The discount rate is I think, appropriate. It's got quite a bit of upside, possibly. So this is the first kind of look at Salesforce. We have to do a lot more before we can really look at it. Does anyone have any questions? What for is cash flow from operations plus stock-based comp minus CapEx? What for? I don't know. I probably I'm attracted to it. I haven't decided. I don't really like to buy stocks or sell stocks after a quick look. I like to focus much more on them. So it'll be a while before I decide. But it looks pretty attractive. Employee stock-based compensation or employee stock ownership plans are pretty complicated, and you should spend some time thinking that through. You have a question, Kitty? Shut up. Shut up. I don't answer questions on individual stocks, and like I said, they don't really have a high PE because the non-GAAP income, net income difference is substantial. They basically have break even on net income, which distorts, or GAAP net income, which distorts the so-called price to earnings ratio. But if you actually do all these add backs, you get a more realistic viewpoint that they're actually earning closer to $2 billion or more in net income. So their actual quote-unquote PE or EV to cash flow is more like 20 times, which for a 30% grower is enormously inexpensive. 8% discount rate because we give Microsoft 6% discount rate. Oh, hey, kitty. Sorry. I just elbowed my cat. Hey, I didn't mean to do that. Cats are resilient, thankfully. You'll see, I want to look at the company software offerings and their positioning in the software market. I mean, I know a little bit about it myself, but we have to do some real fundamental analysis of what exactly it is they're doing. Come up here, kitty. I can teach this cat Excel, and I will. Ow! Why are you scratching me, kitty? She's trying to scratch her nails on this chair. What do I think about their acquisition spree? It's a great question. That's one of the things I'll be analyzing. I am banned from Twitch. Perma-banned. Shut up, kitty. Shut up. No more dog. No, Joe. No. You gotta use the mouse sometimes. Isn't Benioff a billionaire? Alright, everyone. Well, got about 2 minutes to go before I wrap up. 1 minute to go. So thanks for joining.